Welcome to Yahoo Finance Live. I'm Akiko Fujita. Here's what you need to know at 3 p.m. Eastern. Fed Chair Jerome Powell sending a message to investors. The central bank will not hesitate to raise rates if appropriate. Powell going on to say he's not confident the Fed's policy is restricted enough to hit the 2% inflation goal yet. The speech interrupted by climate activists. The message from Powell spooking investors. The S&P 500 falling today on track to snap an 8-day winning streak. This comes as the 10-year Treasury yield rises, with investors weighing the current state of the economy and new commentary from the Fed. The Dow losing 200 points ahead of the close. The Nasdaq also trading lower. And some relief for home buyers. Mortgage rates dropping for the second week in a row. The 30-year fixed mortgage falling 0.25%, the largest one-week decline in a year, according to Freddie Mac. But buyers still having to contend with supply issues, and falling rates could mean more competition. As always, though, let's get you up to speed on the market action with 1 hour left to go in the trading day. As we have said, we've kind of seen the losses accelerate going into the close here, with the Dow down 235 points, the S&P 500 down 37, and the Nasdaq down 136. In terms of sectors we are watching, healthcare and consumer discretionary seeing the biggest hit in the session right now. And as we mentioned, that commentary coming from Fed Chair Jay Powell spooking the markets a bit. We've been watching the Treasury yields closely, pulling back or pushing higher on the back of that. Again, Powell saying that he's not confident that the central bank has achieved the stance that's necessary for that 2% target. You see the 10-year up at 4.6% and the 30-year yield at 4.78%. Airbnb is out with its 2023 winter release. The platform introducing new upgrades to help set better expectations for guests before booking. This comes as Airbnb progresses in laying out a foundation for differentiating offerings for its hosts and guests. To dig into all of this, we've got Airbnb CEO Brian Chesky with us here on set. Tight quarters, Brian, but appreciate you joining us today.
Thank you for having me here. It's great to talk to you.
Let's talk about the winter release, because you are coming on the back of a year where you've talked about really reassessing the core of the business. How does this winter release address that and some of the issues that you saw pop up?
Yeah, I think that over the last 2 years, we've been listening to feedback from our guests and hosts, and we want people to love our service. So we made over 350 upgrades and improvements to our service. The final frontier is reliability. We have over 7 million homes around the world. Many of the guests say what they love about Airbnb the most is that every home is unique, it's one of a kind. But the problem is that, well, it's one of a kind, so you don't always know what you're going to get. Guests have described checking Airbnb sometimes as a moment of truth, where you find out if the home you booked is the home you thought you booked. And this is the number one reason people book hotels. They like the reliability. So we asked, well, what if we could combine the uniqueness of an Airbnb with the reliability that you're more familiar with from a hotel? And that's what we've done. We took over 370 million reviews and a history of customer service calls and contacts. We've created a collection over 2 million of the most loved homes in Airbnb according to our guests. So that product is called Guest Favorites. And I think if you come to Airbnb, you see a guest favorite, you're gonna be happy with it, I think, every single time. So that's the big update we have.
You've talked a lot about some of the issues that you have seen pop up within your core business. Over the last year, you've been quite open about it, saying that, look, coming out of the pandemic, looking at where Airbnb is, the foundation wasn't necessarily as strong as you had hoped. Are you confident with all the issues you've addressed going into 2024, where you've talked about sort of this big product pipeline that we're likely to see?
Absolutely. Not only do I think we have a great foundation, but I think we've made more improvements than probably almost any other company in travel. I mean, 350. And many of these things are things that we're doing and no one else is doing, like upfront pricing. You can see a toggle that turns on a total price display right on the homepage. It's more prominent than other travel sites. So we're trying to really do things that other sites aren't doing.
Let's talk about where travel is right now. We've heard from the likes of Marriott who say, look, travel demand is still strong. It's still very resilient, even if consumers are cutting back in other areas. What are you seeing right now? It's
still strong. I mean, we had a record Q3. We've done over $4.2 billion of free cash flow in the last year. We had a record revenue, it grew 18% year over year. And I think that's partly just because of how strong travel is. I also think, though, that's because of how much people really love our service. 90% of our traffic is unpaid or direct. We don't need a loyalty program to get people to come back to us. Our loyalty is people love our service.
With that said, you have had to address issues about the additional fees that are out there, cleaning fees, service fees. Yes, you have increased transparency as well. Have you seen that change the experience for the platform? What are you hearing from consumers, and are you confident that that's not necessarily a barrier for Airbnb right now?
Well, I think we've made a lot of progress. Just to give you a stat, today, prices in North America are down 3% year over year on Airbnb. For hotels in North America, they're up approximately 10% year over year. So the trend line is good. We got a lot of feedback last year. Based on that feedback, we made a lot of improvements. We created better tools for hosts. Over 1 million hosts have used this tool where they can see how much money other people make in their area. That has led to, I think, more competitive pricing. So we're always trying to take feedback from our guests and our hosts. When we get that feedback, we're relentless at trying to address it. We're always going to be improving our service, but I think that we have now turned the corner. I think starting in 2024, you're going to see new things from Airbnb because we're ready to innovate beyond what people know from us.
So let's talk about what that product pipeline could look like. You've talked a lot about the promise of generative AI. As you think about the products that are coming to market that Airbnb can offer come 2024, how does that integration at its core open things up for the company? What are the products we're likely to see?
Well, I think we should think of generative AI like a platform shift, maybe similar to the mobile phone platform shift in 2008, 2009, 2010. And that platform shift unlocks so much opportunity. I'll give you one example. It used to be very difficult to get in touch with a host before the mobile phone. You would message somebody, you'd book, and you have to wait for them to go home and check their email. But with a mobile phone, suddenly they can message you right away. Generative AI is going to be so much broader than that. It's going to unlock so many different types of businesses. It's going to allow Airbnb to be like the ultimate travel agent. We can be way more personalized. We can understand what you need every part of the travel journey. We can be in the business of not just search, but matching you to homes, experiences, other types of services. I think it's going to open the door.
The ultimate travel agent, is that what Airbnb is aiming for? Because I'm thinking back to before the pandemic. There were a lot of, you added experiences, there were questions about whether, in fact, Airbnb could become sort of that one-stop shop beyond just stays. Is that what you're going for now? And does generative AI allow you to go there, accelerate the process with fewer resources?
Generative AI absolutely allows us to do what we were set out to doing earlier significantly better. As far as what we're going to do, you'll have to stay tuned, but there's some really, really big things coming.
I mean, how much value does that unlock? I heard you say recently in an interview that you think experiences alone could be a $100 billion business.
Yes, and I'm not saying that we can do it. And I'm not saying when that's possible. People have asked me, how big is the experiences market? I think it's completely massive. And the reason why is the mall is now Amazon, the theater is now Netflix. Not as many people go out and they spend time in community spaces. I think we're living in one of the loneliest times in human history. I think people are looking for ways to meet people and to be able to gather around the world. And I think that this is going to be a huge opportunity for a company to do. I don't know if we figured it out. I don't know if another company has. So I think it's going to be a very long game, and we'll see if somebody figures it out.
Finally, let me ask you this, because we are in New York City, where you have said there is an effective ban, that the city has placed restrictions on Airbnb. It's got to be more than 30 days in order for a host to be able to, or for those to be able to host guests. Is there an active conversation that's happening with the city? Is there a potential for a reversal, just given Airbnb's impact on this market?
Well, we've had conversations for 13 years. In 2010, these conversations started. In the period of time, those 13 years, we've been able to work out sensible regulations with hundreds of cities all over the world. Paris has figured this out, London, LA, Chicago. We can go down the list of cities, and they all have different solutions. Unfortunately, I don't see a near-term path because I don't see a huge appetite from the city's perspective to try to, allow Airbnbs in the city, and that's unfortunate. But we're going to do our very best. I think people can find boutique hotels in New York City on Airbnb. If you want to stay longer than a month, you can still book an Airbnb. And a lot of people are starting to book in New Jersey and other areas because you know why? It's just too expensive for a lot of people. Not everyone can pay $500 for a room here.
What do you think happened though in New York? I mean, you had these conversations going. You've had conversations with other cities. You've been able to work out some kind of, not necessarily a workaround, really just come to an agreement.
Yeah, we're in 100,000 cities. We ain't able to work it out. There's only one large city in the world we were not able to come to a resolution in, and that's the city we're in right now.
Why?
I think that there wasn't it's just, I don't know. We've done our very best, and we're always willing to come to the table. It's been really difficult. Like, we are willing to collect from a hotel tax. If people are worried about affordable housing, cities have solutions where they can require a registration system. They can limit the number of nights people are renting. They can require them to list only their primary dwelling. Cities around the world have come up with solutions to be able to solve this problem, and we're always open to discussions.
And just final question, because the argument for those who have been in favor of this de facto ban is that Airbnb listings are bringing up rents, they're bringing up prices.
So if that's true, well, if that's true, and if Airbnb housing was raising rents, and now it's de facto banned, that would mean housing prices would go down. So let's check out. Well, have me back, and let's ask me if the housing prices have gone down.
Okay, we'll have to have you back. Brian Chesky,
Thank you.
Good to have you always. Appreciate you joining us on set here.
Thank you.
We are just getting started here on Yahoo Finance Live. Coming up on the other side, the 10-year Treasury yield rising today while investors digest new Fed commentary. We're going to break down how high yields could affect economic growth. And mortgage rates falling for a second straight week. We're going to explain why homebuyers aren't out of the woods just yet. ARM holdings in the red today, we should point out. We're going to be discussing those results on the other side as well.
Few words are as emotive in American discourse today as healthcare. It's an industry and a system that both insiders and patients agree is broken. From affordability and access to the government's drug pricing negotiations, the challenges are endless. Meanwhile, big box and digital health are pressuring traditional systems. Companies like Amazon and Walmart are thinking about how to get you to think about healthcare while you're shopping. Then there's the excitement and apprehension around AI and what its role is in healthcare. And of course, the buzz surrounding the newest weight loss and diabetes drugs and what it means for other industries. We'll tackle all this and more in a special series starting November 13th, only on Yahoo Finance.
ARM Holdings is in the red today after releasing second quarter results. Its first earnings report since going public. Company beat on the top and bottom lines, but guidance disappointed investors. Joining us now is ARM Chief Financial Officer Jason Child. So Jason, thank you for joining us today. Let's just get right into that report, Jason. The Q3 guidance that missed consensus, and some investors do seem disappointed. Walk us through, Jason, just what you're seeing in the business.
Well, first, thanks for having me, Josh. Really appreciate it. So, first, I would say, we had a great quarter, and we're very pleased with the results. We had record revenues, and for a 33-year-old company, that's saying something. And in terms of the guidance, we actually raised our guidance for full year. We did reduce guidance slightly for Q3, but took it up in Q4, so we're up for the full year. So record revenues, strong beat versus expectations, and raised our expectations. So we're very happy.
And Jason, I also want to get your check on the smartphone market. That could be a challenge for ARM. I'm just interested how you're navigating a kind of sluggish smartphone market right now, what you see in 2024. It did seem, Jason, like some of your customers, like Qualcomm, were feeling a bit better about that market looking ahead.
We do feel good about the market. It bottomed out, I think, back in Q1, our Q1, which would be Q2 calendar for the rest of the world. And we did see some improvement this quarter. We do expect to see stronger growth next quarter and for the rest of the year. We're actually going to flip back to positive growth in this current quarter. That's our guidance. We expect to get back to double-digit growth by the end of the year. So we also see strong recovery.
Jason, it's Akiko here. Even with that said, so much of the excitement, at least around the stock, has been the potential for that AI being a big driver for ARM. You look at where Wall Street analysts have been, it feels a bit split in terms of where they see things moving. Obviously, I know as a CFO, you're not necessarily looking at where the stock is being rated, but I'm curious how you think investors should be looking at that very potential on how significant a revenue driver AI can be.
So we see it as a very significant driver. And the way we measure that is the license revenue, which is us selling designs for our partners to go build various AI applications, technology, et cetera. It starts with selling designs. So we had a record quarter, sold more designs and had more revenue than we've ever had historically. And AI is absolutely at the center of all of that. What will happen next then as those products are actually coming to market, we'll then get royalty revenues from that. So everything we see absolutely indicates that we are absolutely at the beginning of or early stages of a pretty significant investment cycle around AI.
And Jason, specifically just drilling down into AI a little bit more, NVIDIA with its super chip, the GH200, uses ARM CPUs. Just walk us through your relationship with NVIDIA, and is ARM thinking about, deepening and strengthening that relationship even more?
Yeah, well, the company has a very deep relationship with NVIDIA that goes back many years. Certainly, one of the most exciting products coming to market later this year is the Grace Hopper superchip. Grace is the CPU, and that configuration, it comes in a couple different configurations, either 72 ARM cores or 144 ARM cores. That is significant. And so as that comes to market, I think that's certainly going to provide growth tailwinds for us, but also I think really increase the exposure that we have from at least the training side of the AI portion of the market.
Jason, let's talk specifically about China. Certainly something that so many chip makers have had to navigate. You're no different, given that you get a big chunk of your revenue from that market specifically. What does that roadmap look like within the company as you sort of try to navigate around the export controls? It's not just about the U.S., but what's happening in Europe as well. How are you looking at that particular market?
Yeah, China, clearly, it's a complex market for everyone in the semiconductor industry. We're very happy with the results. We actually did have growth in our China business in the last quarter. It's about 20% of our global business. In terms of all the different moving aspects of export restrictions and all the various regulations, we're compliant with everything that we've seen out there. We feel like we're in a really good position to try to satisfy all the various customers that exist, either multinational who have Chinese operations or the ones directly in China. But it is, as you said, it's a moving landscape, and we think we're well positioned to continue to be able to participate through, with the growth of China through our relationship with our joint venture with ARM China.
But Jason, specifically when you talk about the growth that you saw in China, just given that it's 20% of your revenue, you think that type of growth can be sustained even as you get caught up in some of the geopolitics that's not necessarily in your control?
Definitely not in our control. And so all we can do is continue, like everyone else in our industry, to try to be reactive and then work with the regulators to try to figure out what's the right relationship. We do, with our ARM China relationship, have a variety of ways to provide technologies, either directly through ARM outside of China or through ARM China within China. But again, we're going to be flexible and do whatever it takes to be nimble around whatever the requirements, however they may change.
And Jason, let's talk about competition as well. One big competitive risk there would be a chip architecture called RISC-V. Jason, when I talk to analysts who cover ARM, they'll say, that isn't an immediate risk to ARM, but it could develop into one, they argue. How do you think about that risk?
Yeah, I think, with any business, there's always competitive threats, and that's certainly something that is out there. In the most recent quarter, though, we did have a record in terms of the amount of designs that we're selling. So it certainly indicates that in the near term, this is not really any sort of a competitive pressure or really impacting us thus far. In terms of what could happen down the road, we'll see. I think in general, our approach is there's probably, as compute needs continue to become more and more pervasive, I think there's probably, room for different architectures to all win. We certainly have one of the most pervasive architectures and specifically do really, really well when it comes to complex, low power compute requirements. And so I think, we have a really good setup for the next few years. Beyond that, we'll see, but we feel like we're in a pretty good position, especially with also the heavy investments that we continue to make in R&D. And really, I think that's what our customers expect. And as long as we continue to make those investments, we should be in a good place for years to come.
Jason Child, ARM CFO, it's good to talk to you today. Really appreciate the time.
Thank you so much for having me.
Well, ahead of Fed Chair Jerome Powell's comments today was a bond auction that sparked the selling on Wall Street. We're seeing all three major indices in the red right now with just over 30 minutes left to go in the trading day. Let's bring in Jared Blickery on the floor of the New York Stock Exchange for us with a breakdown of today's big moves. Jared.
Kiko, we got some fireworks in the bond market. Let's go to the Wi-Fi Interactive, where I'm checking out the intraday price action on the 30-year T-bond yield. And here we can see at 1 p.m. we had an auction. Didn't fail, but it didn't go as well as anticipated. Low demand, and we saw yields immediately spike right after that. You can see they pulled back a little bit, but are still materially above where they were before the auction. And also tracking the opposite reaction in stocks, we saw the S&P 500, the Nasdaq, Russell 2000 all take a dip, and then you can see they've been drifting lower here. This is something additional. You mentioned the Powell comments. He was talking about the 2% inflation target that, based on the way things have evolved currently, not necessarily on track, leaving the window open, the door open for more rate hikes. And that spooked the market just a little bit, those 1-2 punches there. And I actually have, this is a chart of the 30-year auctions going all the way back to 2009, 2010. This measures the tail on the auction. It's the median yield minus the high yield, a bunch of in the weed stuff here. But what I want you to notice is that what happened today was the most extreme since we had 2011. There was another 30-year auction right after S&P downgraded U.S. debt. That was a real disaster, not only for the bond market, but also the stock market. And all of this is to say that this kind of reminds me of what was happening in the global financial crisis leading into 2011 when we got that debt downgrade. I wrote a daily E-mini S&P 500 futures trading newsletter, and one of the things I was looking out for was the 3-year auction, the 5-year, the 10, the 30-year auctions. I had to be careful around 1 p.m. on these certain dates because we could see disruptions in the market. So are we heading back there? It's quite possible. I was reading Bloomberg's Simon White. His comment was, we are on the road to fiscal dominance where an auction failure is no longer a negligible risk. So more fireworks in the bond market here, bleeding into equities as we've seen many times this year.
Jared Blickery, thank you for that. All right, let's take a look at some trending tickers now. First up, Bitcoin. Renewed optimism about the spot Bitcoin ETF approval driving prices higher. And CoinDesk reported late Wednesday the Security and Exchange Commission began talks with one applicant, Grayscale Investments. So this one, rally continues here at Kiko. Of course, we're still well below that record high, 69,000. That was back in November 2021. Then we had the crash in 22. But we're rallying here. We're now at we're hitting the highest price here in about 18 months. And Bitcoin fans, we know we've been excited. We've been talking to strategists and different investors. At least the crypto fans, very enthusiastic about the idea that maybe the SEC steps in here and gives that spot Bitcoin ETF the official green light. And their hope is that really sparks and motivates more mainstream acceptance.
Yeah, that has long been seen as the next big catalyst for Bitcoin. Bouncing back off the big lows we saw last year, but still at $36,000, well off this, 60,000, near 70,000 highs that we saw in 2021. We should point out we're also seeing a big rally in Ethereum today. Asset management giant BlackRock potentially taking that first step towards an Ether ETF. Delaware's division of corporations, the website, they're showing that there was a registration for iShares Ethereum Trust. So a lot of excitement around there as well. So ETF, crypto, certainly seen as another big lever that could potentially be pulled.
Yeah, I mean, certainly you mentioned BlackRock. It's always interesting. Larry Fink, initially a skeptic, now a believer. I don't know. I mean, Larry talked to the right people or did some research, but a change there. But to your point, too, you can listen. Bitcoin's move today, given a lift to stocks of digital asset companies, too. Check out Coinbase, check out MicroStrategy, both also well in the green.
Okay, let's take a look at shares of Tesla under pressure. HSBC initiating coverage on the stock with the equivalent of a sell rating, saying the company is overvalued for what it's delivering. The analyst had a $146 price target. That's a decline of more than 30% from these levels. Now, you see the stock down more than 6% right now. Josh, it's not necessarily that HSBC is saying long-term, this is not a company you want to invest in. It's just when they're talking about what has driven the stock, whether it is the self-driving, whether it is the Dojo supercomputer, all of these are long-term plays for the company, and HSBC saying that that's going to take a little longer than expected. We should point out they've also highlighted Elon Musk's prominence within the company, saying that presents, in their words, a considerable single-man risk.
Yeah, so to your point, Kiko, they talk about uncertainty around the timing and just the commercialization of Tesla's various bets. So robots, autonomous vehicles, energy storage. I think the money quote here is we see considerable potential in Tesla's prospects and ideas, they told clients, but we think the timeline is likely to be longer than the market and valuation is reflecting. And those comments about Musk were interesting because they said, listen, I think they're saying, listen, he's dynamic, he's charismatic, but they argue that he represents a key man or single man risk, which is interesting because Tesla's tried to kind of trot out different executives, right, expand their profile. But ultimately, when people think Tesla EPS, so they still think Musk.
A single man risk.
That's it.
That word. How many companies can you say? It's just
I can't-
really,
Yeah.
that brand is represented by a single
A lot of
person.
people are in the stock because they believe in Musk, right? I mean,
Yeah.
they are fans. We've had him here on Yahoo Finance. That's part of the thesis. All right, moving on here. Final stock we're going to watch here is Tapestry, parent company of Coach, reporting weaker than expected revenues, but adjusted earnings beat. Stock's higher here after the earnings call. So Tapestry here, owner of Coach, also Kate Spade, adjusted EPS, gross margins. That was ahead of consensus, Akiko. Citi here in a note saying market expectations were pretty low going into the print. So in their opinion, not too high of a hurdle they had to clear. And they go on to say here they do have a buy actually. They have a target of 48. They say that the margin performance I think kind of offset that slightly weaker than expected revenue.
Yeah, the CEO saying specifically in these results that as the company moves forward, we're in a position of strength with meaningful runway for sustainable growth. Global growth also always an interesting one to look at with a brand like Tapestry, just given just where some of these brands are doing, particularly in a market like China. The company specifically looking at international revenue growth of 7%, a lot of that fueled by gains they saw in Japan, 12% there, and 9% in Greater China.
Yeah, and the company is in the midst of buying Capri Holdings, so parent to Michael Kors, and they did say the deal's making progress toward a close. And I know some analysts were saying that should ease some uncertainty there as well. Stock has had a rough, though, 2023. We should know it's still down about 20-25%.
Yeah, these luxury brands always a good gauge of where the consumer is, so one we're going to continue to watch. Coming up on the other side, new comments from Fed Chair Jerome Powell. The Fed Chair saying the central bank will not hesitate to raise rates if necessary. We're going to get you a full breakdown of his remarks. That's coming up next.
Fed Chair Jerome Powell sparking a sell-off on Wall Street by leaving a rate hike on the table. It comes as other Fed officials from Atlanta and Richmond both warning today that the full impact of past rate hikes is yet to be felt. Jennifer Schonenberger has been following this for us. Jen.
Good afternoon, Josh. Fed Chair Jay Powell just wrapping up remarks at the IMF HQ here in Washington, where he said that monetary policy is in restrictive territory, putting downward pressure on inflation. And he cautioned against being misled by a couple months of good economic data, though the Fed chair squarely kept rate hikes on the table. Take a listen.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
The Fed chair emphasized a meeting-by-meeting approach based on the totality of the economic data. Powell said that while third quarter GDP clocked in quite strong, the Fed does expect that to moderate, though the committee is continuing to monitor how strong growth will continue and whether that can undermine progress made on inflation and rebalancing the job market. Now, the Fed chair was also asked about the hike in long-term bond yields, which have actually come down about 35 basis points since the Fed's meeting last week. And he said that the Fed is very focused on tightening financial conditions and how significant that could work into their monetary policy mechanism, though that right now the Fed is very focused on whether to raise rates higher before deciding how long to hold rates at restrictive levels. While Wall Street has not penciled in any further rate hikes and believes the Fed is done in its current rate hiking cycle, officials have penciled in one more rate hike for this year, leaving the possibility open for the month of December. Now, also just want to note that at the beginning of Fed Chair Powell's remarks, he was interrupted by some climate protesters. This is the second time that the Fed chair has been interrupted by climate protesters since he spoke in New York last month. Back to you.
Yeah, this coming just weeks out from COP28. Certainly Fed policy or climate policy around central bank going to be in focus as well. Jen Schonberger, thanks so much for that.
Thank you.
Well, the 10-year Treasury yield rising today as investors weigh the current economic outlook and new comments from Fed officials. Chicago Fed President Austin Goolsbee told the Wall Street Journal the Fed needs to monitor those higher yields to ensure they do not slow down the economy more than expected. The yield on the 10-year rising on the back of those comments from the Fed chair. We saw it rise above 5% last month. Since then, it has pulled back just slightly, but you see right now at 4.6%. Let's bring in our next guest, Eric Ditton, the Wealth Alliance president and managing director. Eric, good to talk to you today. We're not at 5% anymore, at least on the longer ends. But the Fed chair making pretty clear today that he doesn't believe that where things stand right now are restrictive enough. Which camp are you in? Do you believe another hike is going to be necessary in order to bring inflation down to 2%?
Well, first of all, let's just talk about Jay Powell for a minute. Leave it to Jay Powell to ruin a great party. This was supposed to be the 9th day in a row that the S&P would have been positive, the first time in 19 years. Not meant to be. Now, I am in the camp that I don't think the Fed is going to hike again this year. Maybe we get one more hike sometime in the first quarter of 24. Bottom line is the bond market is doing some of the Fed's dirty work. And even though we've had a pullback in yields from 5%, we've had a big hike in yields on the 10-year, looking back the last 3 months. So those higher rates on the long end basically take pressure off of the Fed to do more on the short end. So I'm not expecting any more rate hikes this year.
And Eric, I'm interested in your view of where the U.S. economy is and where it's headed. You know, we're heading to election year. 12 months from now, Eric, how do you see the U.S. economy holding up? You think we're the same, we're weaker, we're stronger? What's your outlook there?
I think, look, the trend is very clear. We're seeing prices come down. We're seeing wage hikes come down. The ISM, manufacturing index, slowing down. Higher rates do take a toll over time. We've been saying for a long time the Fed's medicine is working. It is. The economy is slowing, despite the strong 4.9 third quarter GDP, which was really due to a low savings rate. That was an anomaly. We're not going to see that in the fourth quarter. The bottom line is I see a slowing economy, but I do not see a recession. We've been talking about a recession now for a year. It hasn't happened. Labor market's still pretty tight, still hiring, still not enough workers to fill those open jobs. So I think with a 3.9 unemployment, I think we've got room, we've got leeway, and I think we could very well see a soft landing. That's the camp I'm in right now.
Eric, let's talk about how you're advising your clients in that environment. I'm looking through your notes here. I'm going to start with the very bottom of the list. You talk about small cap being a big opportunity right now. Is that just largely based on how far they've fallen and where valuations are?
Yes, we're really seeing small caps trade at very low PEs, very low valuations. By the way, I don't want to buy the Russell 2000. A lot of those companies are not profitable, but there are great managers out there, small cap value, small cap growth managers who have great track records. But this is a stock picker's market. In a slowing economy, small stocks are going to feel it more than large stocks. So you got to be careful. But I love the valuations. This is as cheap as we've seen in a long time, years.
And Eric, you also like, it looks like dividend stocks. What's your play there?
Look, buy low, sell high. Dividend stocks have really taken it on the chin this year. This is one of the worst years ever for utilities. We're seeing lots of great companies out there with strong balance sheets yielding 5% plus with histories of raising dividends. We're managing money for a lot of retirees. They need two things. They need an income and they need a rising stream of income to hedge inflation. And dividend stocks tend to do that. Bonds do not. So we like dividend stocks.
Finally, Eric, we started by talking about bonds. Let's talk about how to invest in bonds. Treasuries, private credit, what do you like right now?
I like them all. I really like municipal bonds. I think that over time, we're going to see tax rates increase. How are we going to solve these huge deficits? So tax-free bonds make a lot of sense. We're seeing yields we haven't seen since 2007. As a money manager, I am thrilled to see yield. I do like private credit. You got to be careful because it's kind of getting a little manic. And whenever I see everyone talking about something, I get nervous. But there are some great companies out there that have great track records in private credit. We're seeing yields 10% plus. That's very attractive. And there's an opening here. Regional banks can't lend like they want to because their balance sheets are hurting. And that's a real opportunity for other lenders out there.
Eric Ditton, thank you so much for joining us today, Eric. Appreciate it.
Anytime. Thank you.
And coming up, West Virginia Democrat Joe Manchin saying he won't run for Senate again in 2024, but is he leaving politics altogether? We can get you the answer. It's coming up next.
Few words are as emotive in American discourse today as healthcare. It's an industry and a system that both insiders and patients agree is broken. From affordability and access to the government's drug pricing negotiations, the challenges are endless. Meanwhile, big box and digital health are pressuring traditional systems. Companies like Amazon and Walmart are thinking about how to get you to think about healthcare while you're shopping. Then there's the excitement and apprehension around AI and what its role is in healthcare. And of course, the buzz surrounding the newest weight loss and diabetes drugs and what it means for other industries. We'll tackle all this and more in a special series starting November 13th, only on Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
I've made one of the toughest decisions of my life and decided that I will not be running for re-election to the United States Senate. But what I will be doing is traveling the country and speaking out to see if there is an interest in creating a movement to mobilize the middle and bring Americans together.
That was Democratic Senator Joe Manchin of West Virginia saying he will not run for re-election in 2024, but he may not be done with a career in politics. Yahoo Finance's very own Rick Newman is here with his reaction. So Rick, walk us through this news. What do you make of it?
My first reaction is Manchin's wording seems designed to absolutely torment the Biden administration, the people who want Biden to get reelected to a second term. He didn't say what he's going to do instead of running for reelection to the Senate. And his wording was vague enough to make it sound like maybe he actually will run for president of the United States as an independent, or possibly as the candidate for this no labels party, which would absolutely just throw Democrats into a tailspin, because their logic would be that if there is a plausible middle of the road candidate, such as a centrist Democrat, which is what Joe Manchin is, he would potentially take votes from Biden in the swing states that are going to determine the outcome and hand the election to Donald Trump, assuming Donald Trump is the Republican candidate. Now, I have no idea if Manchin intends to do that, if he actually wants to run for president. He may have a different interest, which is perhaps pressuring Biden to campaign more as a centrist. And there could be some behind the scenes deal making between Biden and Manchin. I mean, imagine if Manchin said to Biden, well, I'll tell you what, I will actually endorse you and campaign for you if you move to the center on these issues that matter to me. And those issues have a lot to do with energy. West Virginia is an important energy state, and that's mostly fossil fuels. So what might Biden offer him in return? Maybe a cabinet position in a Biden administration if Biden wins re-election. Joe Manchin as energy secretary, anybody? I'm just playing around with the possibilities here. But this is a wild card for the 2024 presidential campaign.
Well, Rick, the question is whether the 2024 presidential election, we should, by the way, say it's still a year out, whether that is something that is going to be won on centrist issues, right? I mean, I haven't talked to you, Rick, since the results on Tuesday. Democrats had a better outcome than expected, but I mean, what does it tell you about what the key issues are as it stands right now? And is Manchin's endorsement something that could make a difference in that?
I think you could make the case that, yes, it is something that would make a difference. Here's something we have talked about before, Akiko, is this election almost certainly, just like 2020, is going to come down to a relatively small number of swing voters in a relatively small number of swing states. It could be between 4 and 6 states. And we could be talking about 1% of the population in those states. I mean, we're talking about Georgia, Pennsylvania, Michigan, Wisconsin, Arizona, and Nevada. It could be 1% of the vote in those states that turns the election either to the Democrat or the Republican, and therefore determines who wins the whole presidential campaign. So yes, those centrist votes absolutely matter, because those are the only votes that are potentially up for grabs. I mean, we saw in Tuesday's off-year elections, abortion was a big issue that helped Democrats, abortion rights. But anybody who's going to vote because of abortion rights is probably a Democrat or a Democratic-leaning voter who has already made up their mind about 2020. It's that very small portion of voters who are persuadable that are going to turn the election. So yes, it does matter in the center. And one other thing I should just point out, that with Manchin leaving the Senate, there's no way a Democrat is going to get his seat in West Virginia. West Virginia is one of the Trumpiest and most Republican states in the nation. It's an oddity of politics that Manchin, as a Democrat, has been able to hold that seat. But that seat will almost certainly go to Republicans, and increases the likelihood that Republicans will actually take control of the Senate in 2024.
Okay, another thing to watch there. Rick Newman, as always, thanks so much.
Bye, guys.
Well, after 4 months of strikes, U.S. actors are walking off the picket lines and back onto filming sets. Well, that's the hope, at least, as SAG-AFTRA enters a tentative deal with Hollywood studios. Looking for what impact have the strikes had, and have we felt the full effect on streaming services yet? Let's bring in our very own Ali Canal, who's been following all this for us. Ali, in some ways, we've gotten some color from a lot of these studios because of earnings season. What's the sense you get, number one, about how they're thinking about this pipeline and how quickly things could ramp up again?
Well, in terms of ramping up, it certainly seems like once this deal is ratified, once it's passed through, they want people to return to work as soon as possible. But that doesn't mean we're completely out of the woods yet, because looking into 2024, there's going to be long-term impact from these strikes. Now, digging through these earnings reports, there's a lot of the same commentary, especially in regards to free cash flow, since we know that if there's no content to spend money on, you're going to see that cash on hand increase significantly. The big question for me, though, is what that means moving forward, especially as we see companies reaccelerate that spending. And I want to focus on two companies that we saw report earlier this week, Warner Brothers Discovery and Disney, both of which really illustrate what we could see in 2024. And let's start with Warner Brothers, because they've mentioned the strikes quite a few times on their earnings. CEO David Zaslav estimated that there will likely be a few $100 million of negative impact on EBITDA, but there were some other key takeaways as well. Number one, as I mentioned, improved free cash flow, but WBD does expect headwinds to free cash flow next year as the company reaccelerates spending. So those year-over-year comps will likely be pretty tough in 2024. Another point the company made is that this was their, quote, lightest original content schedule in years. They weren't producing anything new. They were delaying shows and movies. That carried over into the TV segment side of the business as well and contributed to declining TV revenue. The company did warn that if this strike were to continue into 2024, there would be some negative financial impact. So these major studios certainly happy that we at least reached this tentative deal. And then if we switch gears over to Disney, they guided to $8 billion of free cash flow in 2024. That's on par with pre-pandemic levels, and it's going to be assisted by lower content spend overall. So even though the strike is over, Disney is still going to be very careful about what it produces, which is a major push from CEO Bob Iger. He's really focusing on quality over quantity content production. Disney said it does expect to spend $25 billion on content next year versus the $27 billion it spent in full year 2023. And then finally, just to end here, the box office, that's going to be a big story to watch in 2024 because we have seen major theatrical delays due to the strikes. Sony's third Venom movie, Warner Brothers' Dune sequel, Paramount's Mission Impossible film, just to name a few. So again, even though the strikes are unofficially over, we're still going to see some impact in 2020.
Alexandra Canal, thank you so much. And coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
You are watching the closing bell on Wall Street here at the New York Stock Exchange. All three major indices ending in the red today, with the Dow down 220 points, the S&P 500 down 35, and the Nasdaq down 128, snapping that winning streak there. We have been watching yields very closely. So much of these moves really on the back of those Treasury yields moving higher after we heard from Fed Chair Jay Powell today, essentially not ruling out another rate hike, saying he doesn't believe current Fed policy is restrictive enough yet in order to bring the Fed back or inflation back down to that 2% target. Let's now turn to some trending tickers. We're watching shares of movie theater chain AMC plummeting, ending the day down nearly 14% today after revealing plans to sell $350 million of stock. The news of the sale overshadowing the company's third quarter revenue beat. We should point out the company swung to a profit for the second straight quarter. But, Adam Aron, who's the CEO, has made no secret about the fact that this is a company that does have liquidity issues, and that they need to raise more, essentially, to keep things going. The company's saying specifically that the sale of the stock would help bolster liquidity, repay, refinance, redeem, repurchase its existing debts for corporate purposes as well. But a company that really is in need of a turnaround.
Yeah.
And it's, what does that look like?
And listen, analysts do emphasize the company has a heavy debt load, and for some, that's a reason, in part, they're on the sidelines. AMC looking to reduce that load where it can. This week, the company also did post these Q3 earnings results, so they beat the street's expectations, and it was on the success, Akiko, of Barbie, which I believe you were a fan of, and Oppenheimer. I didn't see that one either. And on the call, execs talked about the potential challenges because of the Hollywood strikes. Yeah. But of course, then just a few hours later, we got word that at least a tentative deal had been reached there. Apparently, CEO Adam Aron was in fact very excited about that, took to X, where he posted his reaction, hallelujah, apparently he said. So good news there for him. All right, moving on. Shares of Instacart falling today, despite an earnings beat. In a letter to shareholders, the CEO discussed the macroeconomic factors working against the online grocery industry, saying, quote, COVID is no longer a tailwind. These factors include high interest rates, inflation, and consumers receiving less government aid. So Instacart, though, it was interesting because you saw some better than expected results, but number of orders beat, gross transaction value beat. They also offered guidance for the current quarter and full year a bit ahead of consensus. Some capital return news too, but that stock is getting hit today.
COVID no longer a tailwind? I mean, is that a 2023 question? I mean, we've talked about this company seeing a big pop on the back of it, but the investor question has long been, how do you extend that runway? How do you go beyond that? Yes, we've heard from consumers pulling back a bit on spending, but groceries, we've heard generally have stayed strong. So we'll see if it's an Instacart specific story or if it's a broader trend.
Yeah.
Let's talk about shares of Krispy Kreme. Love to end the day talking about donuts. Trending lower today, down about 6.5% after a big earnings miss. Revenue came in a little over $407 million versus $413 million expected. And adjusted earnings per share came in at 3 cents versus about 6 cents estimated. But Josh, here's the story I want to talk about with Krispy Kreme. The company reportedly in talks to expand its partnership with McDonald's beyond its stores in Kentucky.
I didn't know they had
McDonald's to get a donut.
Sure. I go to McDonald's for anything. I didn't hit McDonald's for like 20 years, and then the 4-year-old though became a big fan of the Oreo.
Bring in the kid again.
I read the Oreo McFlurry, and I gotta say she's gotten me back into the scene. The McDonald's breakfast, the Egg McMuffin.
Breakfast is the way to go, I think, with McDonald's.
I'm telling you, you can't miss with that. But here's what was interesting too here. The truest commentary on some of this, bringing back the GLP-1 kind of stories there with Krispy Kreme. Talking about how, listen, no impact now, they told their clients. We don't think that GLP-1 had any impact on the business, at least right now. But it was interesting that they continue to believe the trend puts a cloud over what they call indulgent snack foods.
This takes me back to a Goldman Sachs report that came out looking at the impact from GLP-1. Is that, are we making too much of this? That we're talking about a consumer who obviously is more sort of health conscious, is aware, more wanting to lose weight. I mean, would you be walking into a Krispy Kreme to start with? I, for one, will continue to indulge. Anybody that knows me knows that I'm a little obsessed with donuts. So, you know, we'll just keep feeding and eating.
There's nothing wrong with an obsession with donuts, Akiko. I'm all for it. Moving on, U.S. consumers keep spending despite high prices. However, sentiment taking a toll in October with expectations for little change in November. At Yahoo Finance's Invest Conference, we got to hear from business leaders on their views over the consumer. Take a listen.
I worry that we could have some geopolitical dynamics that could put some more stress on inflation moving forward. And it's fragile enough in the overall equation that, you know, one or two of those things break the wrong way. I think it could ultimately roll down to the consumer.
If in the next 12 months we have a soft landing, if growth stays above potential, if inflation falls further, if real wages are increasing, then I think the consumer confidence is going to be increasing over time.
Here to dig deeper into the state of the consumer is Natalie Cutler, BDO Retail and Consumer Products National Industry Leader. So Natalie, here's the thing with the consumer right now is we have a lot of CEOs on Yahoo Finance. I feel like right now, Natalie, if I put two CEOs in a room and ask them about the consumer, I'm going to get three different opinions, right? I mean, it's really all over the place. I will say, you know, I talked, Natalie, to Klarna's CEO recently, which was interesting because he did say, and listen, that's a unique insight as a buy now, pay later operator into the consumer. He was telling me, listen, he does see weakening consumer spending trends. How are you seeing the consumer right now? What's the state and health?
You're absolutely right. So we're seeing consumer spend staying the same. And the consumers are really in a unique place right now, right? So we're seeing a lot of resiliency coming from the consumer, even in the time of challenges that is out there right now, between inflation continuing to stick around, interest rates potentially going up, and still being at high levels. The debt of the average consumer is pretty high. The average consumer has about $6,000 in debt at the moment. Loan repayment for school loans that just started in October. And you look at all of those things, certainly takes consumer confidence down to a 3-month low. But then at the same time, we're also talking about consumers being resilient. So how do you make sense of all of that, right? So I think what we are seeing is that the consumer resilience is going to, it's like a couple of stages behind, and it's going to catch up. And unfortunately, I do think it's going to catch up during the holiday season, and we're going to see consumers starting to pull back. In fact, we've already seen some of that even on Prime Day, although it was pretty successful for Amazon. But if you dig deeper, you'll see that over 60% of the consumers that purchased products on Amazon were under $20. And only 4% of the consumers made purchases over $100. So that's telling you right then and there that the average consumer is strapped for cash. They have a fixed budget, and they're really trying to fit in everything that they need to buy, whether essentials, non-essentials, holiday gifts. They're trying to pack all that into a fixed budget.
Now, you know, when we talk about the consumer, we talk about like there's one consumer, though, and of course there's different kinds of consumers. Are you seeing differences, let's say, between right now low income, middle income, and affluent, and how they're navigating these different storm clouds?
So you're definitely going to see a distinction between lower income and the higher. So you're always going to have that distinction between the two. The higher income brackets are not as affected by what we're seeing now because of the wealth that they have aggregated, whereas the consumer that is on the lower end of the threshold, their pocket is certainly a lot more fixed. And given where we are with, as I mentioned earlier, inflation, debt, interest rates, their pocket is a lot more fixed, and we're seeing them struggle more.
And Natalie, you mentioned that consumers will start to pull back even more come the holidays. What does that mean from the retailer's perspective? How steep will the discounts need to be?
So it's going to be almost a waiting game between the consumer and the retailer. So the consumer is going to try to hold out for that best price. And we're dealing with a really educated consumer today. Anyone that's going in to do any kind of shopping, whether it's they're going to the mall, they're going to a strip mall, they're going to the supermarket, they have their phones, which will where they can identify, is this the right price? Is this the cheapest price? Can I download a coupon? So there's gonna be that tug of war, so to say, about which retailer is ultimately going to win and pick up that consumer. So retailers really need to understand who is their consumer and what's important to them. Is it price? Is it quality? Is it selection? Or do I need to have that hot ticket item for the holiday season that's going to draw that consumer?
And during the holidays, as they start shopping here, Natalie, any insight into what you think consumers will be after specifically? Anything that you think is going to be really on their radar this holiday season?
So it seems as if the average consumer is going to be going after a couple of things, right? So they're going to go after something that's going to make a big bang, right? You want to get the bang for the buck. So whether it's apparel, because that's really easy, you can get there on a significant discount and still get that big box of sweater and that big gift. It'll make a big splash, so to say, and electronics, because that's always a favorite.
We've seen that, especially around Black Friday. A lot of people jumping in on those deals. Natalie Cutler, good to talk to you today. I appreciate the time.
Thank you.
Well, coming up, pharma company AstraZeneca entering the weight loss market with an oral GLP-1 drug. Yahoo Finance's Anjali Kamlani speaks with CEO Pascal Soriot on the other side. We'll be right back.
AstraZeneca out with earnings today and some news on re-entering the GLP-1 race. Joining me now to talk about all of that and more is AstraZeneca CEO Pascal Soriot. Pascal, thank you so much for joining me today.
Thank you, Anjali. It's really a pleasure to be here with you.
So talk to me about earnings. You came out with some really good results. I know there's a bit of pipeline shifting going on to make room for the GLP-1, but let's talk top line right now. What happened today?
Yeah, we actually, first of all, announced tremendous financial results. We continue to do very well. And from a pipeline viewpoint, we continue also to do well. We've announced the licensing of a novel GLP-1 for the treatment of obesity, but also for the treatment of comorbid conditions like kidney disease, heart failure, elevated cholesterol, or hypertension, in combination with many of our other agents, and many other positive news across the portfolio in cancer, rare disease, respiratory disease, cardiovascular disease. So a lot of exciting news.
Definitely. Talk to me about this announcement with the GLP-1. So you have a new partner in China, and you're going to be pursuing this oral GLP-1. You yourself, or the company rather, has had a couple of setbacks in this space. Why is the GLP-1 space so important?
Well, GLP-1s are important because they, of course, drive weight reduction, but they also have now been demonstrated to have benefits beyond weight reduction, benefits in kidney disease, and more to come. This company is called Ecogen, and they are both based in China, but also in Boston. So they are, a company with two legs, if you want, one in the United States in Boston, and also in Shanghai in China. And they've developed this oral GLP-1. I believe the next phase of weight control will be with new agents, either oral agents or products that deliver weight reduction that is more durable when you stop taking your treatment, but also affects more fat reduction and less muscle reduction.
And that's one of the reasons why you're looking to combine it with Forxiga, right? If I'm saying that correctly.
We're actually looking at this agent as a treatment of obesity, but also importantly as a treatment of patients who have diabetes, patients who have kidney disease, or heart failure. And here we can combine it with our product called Forxiga, which has been developed for many years and shown tremendous results in kidney disease, heart failure, and also of course, diabetes. But we can also combine this oral GLP-1 with other products in our pipeline. We have an oral PCSK9 for the reduction of cholesterol. We have a product called Baxdrostat for the treatment of severe hypertension. So many opportunities to combine this product with other products we have in our pipeline.
And that really speaks to the emphasis and the excitement around this space, especially when pushing for, say, insurance coverage, as I understand it. So definitely a good play there. Talk to me about a broader portfolio. Oncology, obviously a big part of it. Right now, how are you seeing things in terms of how the year has gone by, and what are you looking for in the upcoming year?
In oncology, you mean?
Mm-hmm.
Yes. Well, in oncology, we've been working hard over the last number of years to continue developing our portfolio. We have a number of products in the market already to treat breast cancer, lung cancer, prostate cancer, ovarian cancer, and we are further developing those products in additional indications. The oncology franchise grew by 20% in the first 9 months of the year. And we are now in excess of $13 billion, with, of course, a strong presence in the United States. And beyond this, we are working on a portfolio of antibody-drug conjugates. Those are products where you combine a toxin with an antibody. An antibody will deliver the toxin to the cancer cell, as opposed to traditional chemotherapy that affects cancer cells, but also healthy cells. We're also working on new technologies like cell therapy and T-cell engagers, which is a specific type of products that will engage the T-cell in your immune system. And those are new technologies that will really open up completely new approaches to the treatment of many cancers.
When it comes to all of this and looking at your portfolio, one of the things we just have to look back on, of course, is COVID and the vaccine there. I know decreasingly a part of the portfolio. How do you think you're prepared? We've seen a lot of companies sort of struggle to maintain, diversify, and grow beyond the windfall that came from the pandemic. How do you think AstraZeneca is holding up in that light?
Our focus really has been on antibodies that will help patients with immune deficiencies and could be exposed to be infected with COVID. The vaccine we developed and commercialized a couple of years ago was really a one-off for COVID to help, and we delivered 3 billion doses, and it has been estimated that the vaccine saved more than 6 million lives globally. But fundamentally, our R&D effort has been around antibodies. Patients who have immune deficiencies, for instance, people with blood cancers, people who have been transplanted, people who have immune diseases, those are not really well protected by vaccines. Even if you give them 2 or 3 shots of vaccines, 4 shots, the response is usually moderate. So they need additional protection. And our focus has been on developing an agent that could help those patients over a long period of time. So we're developing a product that would protect patients for 6 months. Beyond this, we're also working on antibodies to protect patients against other viral infections. For instance, we've just launched in collaboration with Sanofi a product we developed over many years called Befortus for RSV infections in babies, newly borns. And this year there's a substantial RSV infection rate. And so we have a lot of demand in the US, but also in Europe for the protection of babies.
Absolutely. Yes, that market especially growing with the newer vaccines there. Talk to me about, broadly speaking, I think one of the important things, especially for a company like yours, has been the Medicare drug pricing negotiations that you're facing here in the US. I know you did previously mention you're engaging with those negotiations. How has it been panning out so far in terms of what you're prepared for and what the expectations are? Do you think that this is going to have really material impact on AstraZeneca?
Well, first of all, I think should recognize there are some positive aspects to the IRA. In particular, the fact that copay cap has been introduced, where patients will not pay ultimately more than $2,000 a year for the entire pharmaceutical bill, whichever medicines they need to take. And those $2,000 will be spread over 12 installments. So that's a positive development. What we have found more challenging is, of course, the impact that these price reductions could have on innovation long term, even though we recognize every government has to manage their investment in pharmaceuticals. But the most important problem that we saw was the fact that products for rare diseases are not sufficiently protected. There are 7,000 rare diseases in the world. Very few have a solution, very few have a treatment. And it's important to stimulate R&D and innovation for rare diseases. So our advocacy has been, rather than start the clock of this period of time after which the price negotiation will start, rather than start the clock when you launch the product, please start the clock when the product loses its orphan drug status, as decided by the FDA. So that would give rare disease products a little bit longer protection and would stimulate development for rare diseases. So it's a little adjustment to the IRA, if you want. And I know there is already some efforts in Congress to adjust, to introduce legislation to adjust the IRA on that front.
Well, definitely good to hear. And really quickly, I just want a yes or no. Do you think that the GLP-1 front is going to eventually become a large part of the portfolio, or do you think that it would be balanced between everything else?
I think it will be an important product as a monotherapy, but also in combination with the rest of our portfolio. But we have so many other innovative products in development in cancer, outside of cancer. I really hope that our cell therapy portfolio develops nicely, and we can then see potential cure to certain types of cancer or durable remissions.
Absolutely. Well, we'll have to leave it there. Thank you so much again for joining us, AstraZeneca CEO Pascal Soriot.
Well, big news in housing today. Mortgage rates coming down. The 30-year fixed now sits at 7.5%, falling 0.25% from the week prior. As Josh laughs at this one, that's the largest one-week decline in a year, according to Freddie Mac. And some context for those of you why we're laughing. I mean, I'm sort of convinced that at Yahoo Finance, they leave these discussions up to us because we are the two in the market for a house that cannot find a house. But in all seriousness, 7.5% roughly is what we're talking about. Is that enough to get current owners to sell? Because at the end of the day, it is about the inventory. If you've already got a rate that's locked in at 3%,
Yeah.
7.5%. You're going to go look for a home, another home, and take on another 30-year fix at 7.5%?
No, so we're getting, I guess it's a kind of breather we're getting here. I mean, we're not at 8% anymore, so that's something. But of course, you're way higher than you were just a couple of years ago. And to your point, you're watching prices. I mean, there's no inventory. It's not out there. So prices are going to stay elevated. We had the economist Mark Fleming on this week. We were talking to him. We asked him this question. All right, so you're down to 7.5%. Does that kickstart the market, the housing market, Mark? And Mark said, no, it's not going to, he was not optimistic about that.
As a potential buyer in the market, what's
the
rate?
Kiko,
What's the rate at which you become optimistic? Is it 6%?
And we asked him that.
Right? 5%?
What's the magic number?
It's not coming down to 5%.
No. We did ask him that. We said, is it 6, 7? It's hard to put a bogey on this. I mean, to your point, if you're an owner, why do you sell? What motivates you? You're locked in at 2 or 3%. Now, sometimes you'll hear this argument. You'll say, well, people say that, life moves on, right? People get married, they get divorced, they have kids, kids go to college, there are deaths in the family. But that doesn't seem in and of itself, life events, enough to really break through this impasse.
Well, exactly. I mean, that's what it comes down to. If you're talking about divorces and deaths in the family, I mean, how big of a market is that really? Is it going to move the needle? You could argue that new construction, which we keep talking about, it's going to take a little longer, but that is what could bring more inventory to the market as opposed to existing homes. And of course, we're talking about this on just sort of personal experience, right?
Yeah,
I mean,
it's all personal.
You've seen it.
It's important because it relates to me. Exactly. Yeah.
And we see it. The lack of inventory in my Redfin feed.
Right, we'll stay optimistic, Akiko. Let's stay optimistic. Come on.
Okay, coming up on the other side, we're talking about autonomous vehicles. I got to take a ride in one of Waymo's self-driving cars and spoke to the company's chief product officer about the safety of the vehicles.
For the first time, we have an oversupply of EVs. So manufacturers are cutting prices. So I think consumer sentiment is changing in terms of affordability. So I think that's really going to help.
The EV industry is going to change the future versus what combustion engines have been doing. So to build the EV charging infrastructure out there, we probably need another $10–20 billion on top of the $7.5 that's been set aside.
The benefit of the Inflation Reduction Act tax credits hasn't been as much as analysts would have thought this time last year. What we've seen so far, at least with the early entrance into the EV pickup market, there's been a strong preference for the gasoline-powered options.
You have to break the dominant paradigm of charging and saying you don't have to go depot or fueling station. You can charge at work, you can charge at home, you can charge at your doctor's office or the grocery store.
And so I think there needs to be more energy put into addressing the issue for apartment dwellers. And it's not a simple problem. It's probably the single most challenging problem we have in the EV space.
We polled over 1,000 people here. I found that 57% of respondents said they were not likely to purchase an EV, whether it was a new EV or new to them. Only 31% said they were likely to purchase an EV. Education is sort of key here if the country's going to see, the Biden administration's 50% mandate of EVs by 2030.
The more challenging parts are going to be the use of high-intensity, fast-paced chargers. Those are like little industrial facilities, and accommodating them on the grid is going to be a little trickier.
The last 2 years have been the most productive in terms of public policy regarding electric vehicles in our history. A lot of work still to be done, but the pace is really accelerating very quickly.
With school districts, their depots are already largely operating at the max. So coming in with electric vehicles, where we need to install a lot of charging stations, has a significant impact on the ability of school districts to electrify in certain locations.
The long term is just infinite. This machine can be used for endless use cases. It can rescue people, first responders. This is the first couple of units already pre-ordered, and then scale up production from there.
I'm Akiko Fujita in San Francisco, where I am here to get a glimpse into the future of self-driving cars. Alphabet's Waymo launched its paid driverless service roughly 2 months ago here in the city. It is still largely limited to San Francisco and Phoenix, but it's quickly expanding. So to talk about where things are headed, we've got Sashwat Panigrahi joining me here. He is the Chief Product Officer of Waymo. You've got roughly 250 cars in your fleet here in San Francisco. You're going to help me hail one?
Absolutely. Let's take one.
All right, let's get out the app.
You can see here that we can be picked up in as early as 3 minutes. That gives an idea for the passenger to prepare. Be on the ride. We can choose, say, Chase Center, pretty popular destination here, and we can request the car anytime we want. I'm unlocking the doors right now, so that's open for us.
And so now we just press start ride?
Yeah, let's try it.
Okay.
What do you want to do?
Hello from Waymo. As we get going, just give us 1 minute to cover a few riding tips.
So you've been at this service, 2 months in San Francisco, but you've been operating paid driverless services for roughly 3 years. What have you learned about this technology and how far along it is?
Oh, right now it's already prime time. As you saw, we saw a pretty dense area. We were able to pull up, pick all of you all up and navigate around busy streets. So it's already, it's one of the densest areas in the, United States when you look at San Francisco downtown. And we're having tens of thousands of rides here. In Phoenix, we have been doing it on high-speed roads. We're the first to do airports. So what we're finding is when you combine these two locations, a place like LA is a combination of the densest parts of San Francisco and some of the high-speed roads in Phoenix. So when we go to a new place now like Los Angeles or Austin, the technology is scaling pretty amazing. From the get-go, the performance is pretty solid.
Safety's still a big concern when you think about the passengers themselves, right? A lot of this is about sort of building trust.
Yep.
There have been recent incidents of a passenger getting pinned down under a car. There was a car that was stalled. There's cars that have sort of confused the lights from the emergency vehicles. I realize those are cruises from GM, not necessarily Waymo, but how do you get to a point where you build that trust and the technology meets where the passenger wants to be?
Absolutely. So on safety is the core of everything we do, and it's been the prime motivator for us ever since we began this, when this felt almost like a dream. And right now, the most powerful thing is actually we have published the results from our fully autonomous rides. From the first million, there were no injuries. There are no contacts with any vulnerable road users like pedestrians and cyclists. We have, with our recent Swiss Re paper, we have shown that we are dramatically better in property damage claims or any other forms of claims. So just the empirical record is already beginning to show those benefits. And furthermore, I would say that we have tested 20 million plus miles.
That's how many miles you've run in all the cities combined.
With a test driver, for example, even before we began doing all this, and that's more testing than all other companies combined. And also for many more, 20 billion plus in simulation. As you and I are speaking right now, 25,000 simulated vehicles are testing out harder and harder scenarios in our simulator.
How does software, LiDAR sensors, determine the intention of somebody that's outside of the car?
Great question. So it's critical to be able to anticipate what they're going to do. So it's not just about detecting somebody's there, but what they're going to do next. And the short answer is tremendous amount of machine learning. So we have had tons of data from just our own driving. We were talking about the 20 million miles of testing. Incredible amounts of investment into machine learning before it was cool. As you know, we have been at this for 10 plus years. And then immense amount of infrastructure as well. So just the amount of training, the degree to which it can predict what a pedestrian is going to do based on just the beginning of the movement of their hand with key points and other factors, the prediction is pretty phenomenal as to how vehicles, bicyclists, pedestrians are going to take their next steps. But you see those two pedestrians, for example, over there at that intersection?
Yep.
So sometimes what you don't know is, are they just standing there and having a chit chat, or are they intending to cross? And in these dense areas, the millimeters matter. Based on that, you can guess, are they about to, get out or not?
I'm thinking back to where self-driving technology, the players that were in this space were. Even 5-6 years ago.
Right. There were many more, right?
There were many more. Today, we're talking about Cruise as your main competitor. You could argue Tesla's in there, but certainly not operating at a level 5. How do you get to a point where this is profitable?
Yeah. So, we were talking about the hardware earlier. So already this generation of hardware is dramatically cheaper than the generations before. And furthermore, over the course of this year alone, we have, drastically reduced the cost per mile, as an example. So I think we are well on our way to bringing the cost down substantially. And with the kind of reception we're getting from the riders today, we believe that we don't have a specific timeline to share, but the rate at which we can bring the cost down now, we feel pretty confident about.
So no timeline, but how much more would you have to scale in order to make this, to bring the cost down further?
You're right. There are two elements of costing down. One is the raw scale, and the other is just the cost of the hardware, some of the operational costs around it, and so on. The latter two are coming down pretty sharply, and the scale is also well on its way, but not too far.
Almost there. Don't forget your belongings.
So, we've had a chance to drive around the city for roughly 30 minutes now, right? I mean, as you look to where this is all going, not just San Francisco, but major cities, what percentage of cars in these cities are going to be fully autonomous?
Well, what we can tell you is that definitely the technology is there. You were in the densest part of San Francisco. The economics is improving rapidly. Rest, we will see where it goes and how fast it can. What we do know is that the more of those miles are autonomous, the safer they will be.
Well, that was Waymo Chief Product Officer Sashwat Panigrahi joining me in San Francisco there to talk about the future of driverless cars. Certainly a lot that's been happening in this space, Josh, not good headlines. We're talking about Alphabet-owned Waymo there, but GM's Cruise now recalling roughly 950 robo-taxis because of that very incident we talked about in that piece, a pedestrian getting dragged under the car in early October. Today, we learned through several reports that the company is also announcing layoffs for contractors. So it feels like, on the one hand, we're sort of looking at self-driving deployment on a much larger scale than we saw several years ago, but that safety issue continues to come up.
Yeah, it is interesting, though, because how many companies are putting so much time and effort, money into this tech? So Alphabet and Waymo and GM and Cruise and Amazon and Zoox, even, talk about, Apple and Project Titan. We don't know as much as what's going on there because Tim Cook doesn't like to talk about his product pipeline, but clearly there are these risks, and we're talking about its safety, as you're discussing, its cost, its regulatory challenges, but clearly a lot of these companies think there are just big returns that are possible to justify the kind of investments they're making.
Yeah, and in that interview, I asked him, what is the case for self-driving, right? You could argue 10 years ago, maybe a little more, there's so much excitement about how this would lead to efficiency in cities. You could argue some of that has died down since, but he still says that it is about safety at the end of the day. And I guess the question would be, we're so used to driving with human drivers on the road. Is it about the coexistence that makes it a little more challenging? If it was all autonomous, would it be a little safer? And these are all questions that still need to be wrestled, but it is still a very high cost operation. And that's why you heard him talking about the scale that's needed in order to make it profitable for a company like
And listen,
Waymo.
and investors pay attention. We've had Tesla investors come on the show and they talk about this as a foundational reason they're invested. They're believers. It's why they're not traders, they're investors, so they're thinking 3, 5, 10 years out. But they made the case for this. And other companies, interesting, they even try to put kind of bogeys on what they think it, like GM, for example, they talk about, they think Cruise could generate 50 billion was their target by 2030. So you even see some of them trying, even though it's early days, to put some financial targets out there that Street and the investors can think about.
And by the way, we were in San Francisco, but Waymo's been offering paid driverless service in Phoenix for a bit longer. You can hail a Waymo to the airport. They've started limited service in LA, but I have to tell you, it's still jarring to me, right? When you're at a stoplight and you look over and you just, there's nobody there.
Yeah.
I can't get used to that.
I wonder if it's generational, right? Maybe it's just us. Maybe
our kids will
maybe the next generation.
They'll be surprised when they see a driver.
Total sense. Open up an app, something comes by, it swoops you off to the restaurant, right?
Yeah, I don't know.
They're not taking Dad, I'll tell you that much. Yeah.
A way to keep Dad away, right? We'll see where it goes, but certainly an interesting time right now for self-driving cars. All right, coming up on the other side, ahead of Veterans Day, we're going to speak with 2 veterans about the triumphs and challenges of launching their own businesses. That discussion is coming up after this short break.
Veterans Day is around the corner, and we're highlighting veteran-owned businesses and looking at the challenges of starting a company after serving and how they're supporting other veterans trying to assimilate back into everyday life. Joining us now is Zach Houston, CEO and president of Pillars of Valor, a coffee company based in Minnesota, and Steve Gagne, founder of 14th Star Brewing Company. So, Zach, let me start with you and just talk to me about the company. How'd you get this idea to start the company?
Yeah, hey, thanks for having me. Zach Houston, Pillars of Valor. I started the company, to be quite frank, I was, I almost became one of the statistics that you hear about. And this is one of the first times I'm publicly talking about it, but I almost came one of the veterans that committed suicide. And I called one of my buddies, I sat down, I paused, and I got lost. And out of that came a great conversation. And my buddy Caleb is a guy that's in the coffee industry. And I said, Caleb, I'm like, how do we get more people to sit down and talk and have that moment where they can connect with people? So my buddy Caleb, he's like, well, what do you want to do about it? And I said, Caleb, I think God's calling me to say, I should start a coffee company because of how this is coming about. And Pillars of Valor was born from that moment. And I launched it last November 11th on Veterans Day, and I give back 7% of all my top line revenue to a local veteran company, or excuse me, a local veteran nonprofit organization. And I'm pretty excited about where it's going, the growth that it's had, and we can talk more about the challenges that we face, but that's kind of the impetus of how it started and why Pillars of Valor is what it is.
Zach, when you talk about some of the challenges that you faced prior to starting this, how much of that stemmed from the challenges in transitioning back to life back here, after your deployment? Can you talk a bit about that and the road that it took to find what that next step would be or the next chapter would be for you? Yeah, so going through 12 years of the service, I started when I was 17. I joined and went to basic training, and I spent a significant portion of my life being in the service, and I left in 2009 when my daughter was a year and a half old, and I came home from that deployment, and she's 2, and I spent a lot of time away, and now she's a big part of my life, and she's 15, and what happens is you lose a big part of that fabric of your life, and it's a tough transition for people as they go from being part of this big ecosystem of life into like how do you mesh back into everyday world. And so there's one day you're in the zone of this multi-million-dollar machine of a cog of fighting a war, and the next day you're at home with your family. So the buffer of like the old World War II stuff where you're getting on a ship and you're coming home and it's months and it's weeks, it's now days. And so the challenges are tough. The ability to make it so that people can transition back in, it's hard, it's real. And people think of veterans as the ones that were like old World War II Vietnam veterans. They're not. They're the guys you're going to hear from today, myself and the gentleman with the brewing company. And it's a different face. It's a different generation.
And Steve, I want to turn to you now and just tell us more about 14th Star Brewing Company.
Sure. Yeah, 14th Star started as a daydream in the mountains of eastern Afghanistan. My best friend and I were stationed over there. It was our second combat tour together. And when you're deployed, there's a couple things you think about, one of which is the day you can get out of the Army. And the other thing is, you think about beer. And we'd been longtime homebrewers, and we wanted to think about what we were going to do after the Army, and something that was going to have an impact, something that was going to matter to our community and to our fellow veterans. To Zach's point, there are a lot of veterans who they don't hit the ground running, and they can use some assistance. And so we set out to start the brewery not just to create the world's greatest beer, which I think we've accomplished, but I'm biased. But we set out to create a business that actually mattered and made a difference to veterans. And in that respect, I think we also succeeded.
Steve, what are some of the lessons that you learned during your time in the Army that you've been able to apply to your current business?
Yeah, so I currently teach business at the University of Vermont. That's my real job. I have a team here who essentially runs the business based on our guidance. We have a fantastic team here. But what we've learned in the service is planning, leadership, establishing direction, establishing clear goals, developing your subordinates, and ensuring that they all understand what the final goal and the final purpose is. And once everyone is aligned with those goals, with the company's values, you can accomplish some really amazing things.
And Zach, turning to you, I know giving back to veterans is an important part of your business. You want to pay it forward. How do you do that at Pillars of Valor?
Yeah, thanks. Great question. So what we do is we give back 7% of the top line of all of our revenue from the packages of our coffee. I got a little bag here to show you. We sell it at retail, whole bean coffee, and that's the engine that generates the give back. And what we do is we give it to currently to a local nonprofit. It's called Minnesota Military Appreciation Fund, and their whole purpose is to generate a mechanism to create grants for veterans who've served in combat since 9/11. And when I came home from Iraq, I was a recipient of that grant. And so I couldn't think of a better way or a better place to start the giving to make it come full circle than this organization. And so that's where I donate my 7% back to. As this thing scales, as this thing gets bigger, as the momentum grows, I have lots of different plans of what we can do with it and help it grow. So it's a brand that people can stand behind. It's a brand of unity. It's a brand of bringing people together.
And Steve, looking at your brewery, your beer is distributed in 9 states now, as I understand it. What's the grand vision for you? Where do you go from here?
So the grand vision is to continue to make an impact on a larger and larger scale. And although the alcohol industry is condensing and getting smaller currently, most companies would take this time to hunker down and play safe. And we're getting very aggressive in 2024. The British SAS say, "Who dares wins," and we're betting on breakout success in 24. Zach, not to be outdone, I got a product shot right here, buddy.
Yeah, man, yours is fantastic. Good for you. I'd have one with you if I was with you.
Zach Houston and Steve Gagne, guys, thank you so much for joining us, for your time, and thank you both for your service.
Thank you for having us.
Thanks, I appreciate it. They're turning the lights out on me.
Coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Fed Chair Jerome Powell sparking a sell-off on Wall Street by leaving a rate hike on the table. Powell saying that monetary policy is in restrictive territory, putting downward pressure on inflation. But he cautioned on being misled by a couple months of good data. The Internal Revenue Service is releasing its tax brackets for 2024. The agency is raising the income thresholds for each bracket, applying to tax year 2024 for returns filed in 2025. For 2024, the top rate of 37% applies to individuals with income tax or taxable income just above $609,000, married couples filing jointly earning $731,000. And some relief for home buyers. Mortgage rates dropping for the second week in a row. The 30-year fixed mortgage rate falling 0.25%, the largest one-week decline in a year, according to Freddie Mac. But buyers still have to contend with supply issues, and falling rates could mean more competition.
And here's what to watch next week. Econ data galore. We're going to get the latest read on inflation with CPI out Tuesday. Street expecting prices to rise 0.1% in October versus 0.4% in September. We'll also get a read on producer prices with the PPI out Wednesday. U.S. retail sales also out on Wednesday. And as mortgage rates fall further away from 8%, we're going to get housing data with home builder confidence out on Thursday, as well as housing starts on Friday, and then earnings on deck as well. Next week, we're going to hear from a slew of retailers. Home Depot, that'll be on Tuesday. Target, TJ Maxx parent company TJX, and Chinese e-commerce giant JD.com. That's all coming on Wednesday. And Thursday, before the bell, we're going to hear from Walmart, Macy's, and Alibaba. After the bell, we'll get Ross and Gap. And finally, over to Washington, D.C., government shutdown looms for the second time this year. On the last day of September, lawmakers averted a shutdown with a short-term bill just hours before the deadline. Now funding is set to expire again on November 17th unless Congress acts. That'll do it for Yahoo Finance Live. Have a great night.